The market just opened on this Wednesday, November 12th, and Navitas Semiconductor, ticker NVTS, is already showing us exactly what kind of stock it is. As of the 9:30 a.m. Eastern open, the stock gapped up significantly, opening at $9.48 a share. That's a massive 17.3% jump from yesterday's close of $8.08. But here's the immediate reality check. In just the first few minutes of trading, it's been in a wild, volatile channel, already hitting a high of $10.21 and a low of $8.92. This isn't a stock that's gently waking up. This is a stock that is a full-blown battlefield, and today's action is a direct continuation of the chaos we've seen all month. The immediate hook, the thing that price doesn't tell you, is that this volatility is almost certainly being driven by one of the highest short interest ratios on the market. We're talking about a staggering 27% of the entire float being held by short sellers, all betting on this company to fail. What you're watching right now is a violent tug-of-war between that massive short position and a new, desperate bull narrative. The general expectation, the story you'll hear in most headlines, is that Navitas is a cutting-edge AI play. It's a partner for Nvidia stock, a critical enabler of the new 800-volt AI factory architecture. The common belief is that as AI data centers get more power-hungry, they need the gallium nitride or GaN technology that Navitas specializes in. This is the story that has propelled the stock and captured the imagination of investors using the Robinhood app or the SoFi Invest platform, seeing it as a way to get in on the next big thing, a supplier to the giants. That's the simple, clean, powerful expectation. But the reality is so much messier, so much more complex, and frankly, so much more dangerous. The real story of Navitas right now is not one of simple growth, it's one of a painful, strategic, and high-risk pivot. The company just reported its third-quarter earnings back on November 3rd, and to put it bluntly, they were a disaster by traditional metrics. They missed analyst expectations on earnings, posting a loss of 9 cents per share versus the 5 cents expected. Revenue was even worse, coming in at $10 million. This wasn't just a small miss. This was a 53.4% decline in revenue year over year. And it gets worse. Management guided for the fourth quarter to be even lower, projecting revenue of just $7 million. This is the reality that sent the stock plunging 22% in the days following that report. Why is this happening? Because Navitas is intentionally abandoning its old business. They are walking away from the low-margin, high-volume China mobile charger market that built the company. They are, in effect, shrinking themselves to almost nothing in the hopes of being reborn as something new. This is Navitas 2.0, as management calls it, and it's a bet the company move. Now let's tie this back to the recent stock movement because it's been truly insane. After that 22% post-earnings collapse, the stock didn't just die. On Monday, November 10th, it exploded 22.4% higher on massive volume. Yesterday, Tuesday, it saw 45 million shares trade hands, far above its 26 million share average. That wasn't fundamental buyers. That, almost certainly, was a massive short squeeze. The 27% short interest is the powder keg, and any good news, or even just a lack of bad news, can set it off. Today's 17% gap up at the open is likely another squeeze. It's a technical battle, not a fundamental one. This is what makes a stock like this so difficult for the average person doing some self-investing. They see the Nvidia stock partnership and buy in, not realizing they've just walked into a war between hedge funds. You have some analysts, like Needham, who see the long-term vision and raise their price target to $13. But then you have Rosenblatt and CJS Securities who downgraded the stock, with Rosenblatt warning that the 800-volt AI data center market Navitas is chasing might be premature, with real revenue not expected until 2026 or 2027. This is the kind of analysis you need to find, whether you're using a full-service platform like Fidelity or Interactive Brokers, or just trying to get good investment help online. The headlines tell you the what, they rarely tell you the why and the when. So, what does Navitas actually do? This is the part that often gets lost in the stock price chaos. The company designs and sells power semiconductors. Their two big technologies are gallium nitride and silicon carbide. Think of these as the next generation of silicon. They are dramatically more efficient, smaller, and lighter than the old technology. GaN is perfect for things like data centers, solar inverters, and fast chargers. SiC is a higher power technology, and its sweet spot is the electric vehicle market. Think onboard chargers and drivetrain components. Navitas is one of the only companies that is a pure play in both GaN and SiC, which is its unique selling proposition. The entire thesis for Tesla stock and other EV makers relies on squeezing more range out of every electron, and SiC is how they do it. The entire thesis for the AI boom, for Nvidia's massive GPUs, relies on packing more and more power into data centers, and GaN is how they'll do it without melting the buildings. Navitas is positioned at the center of these two massive trends. That's the bull case. That's the expectation. The reality, again, is the timeline and the competition. This Navitas 2.0 pivot is a jump from a pond into an ocean filled with sharks. By abandoning the mobile market, they are now going head-to-head with giants like Infineon, ST Microelectronics, and Wolfspeed in the high-power SiC and GaN space. These are not small companies. They have deep pockets and decades-long relationships with automotive and industrial clients. The Nvidia partnership is fantastic validation, but it's not an exclusive contract, and as analysts pointed out, the real revenue is years away. The same goes for their 40-plus EV design wins. A design win is not a purchase order. It's the start of a long, multi-year process of qualification and testing. So, while the expectation is Nvidia partner, the reality is competing for 2027 revenue. This is a critical distinction that many investors, especially those on simpler platforms like Robinhood stock trading, might miss. This isn't a stock you just buy and check on your Fidelity mobile app in a year. It's a stock you have to watch daily. This is also where you see the split in online investing strategies. A stock this volatile, with a 27% short interest and a PS ratio that has been as high as 40 or 50, is pure speculation. It's a trader's stock, perfect for the advanced tools on an interactive broker's trading platform. It is not a stock that a service like Schwab Intelligent Portfolios or a Fidelity Wealth Management Advisor would likely ever put in a retirement account. They would give you exposure to this theme through Fidelity ETFs or Fidelity mutual funds that hold a basket of semiconductor names, diversifying away the single stock risk. This is the definition of a speculative holding in an individual brokerage account, and it's where many retail investors get burned, chasing a story without understanding the financials. The financials right now are terrible. The story is fantastic. Your job as an investor is to decide which one will be right in 3 years. Looking at the institutional ownership, the big smart money is also divided. Vanguard and BlackRock have large passive positions, which is normal, but hedge funds like Millennium and Renaissance have been actively adding to their stakes. They are making a bet on the pivot, or perhaps just on the volatility. Looking forward, the picture is one of extreme, binary outcomes. This is not a stock that is likely to just drift sideways. The bull case, the expectation is that this pivot works. Navitas 2.0 is a success. The $7 million Q4 revenue guidance is the absolute bottom, the trough of the transition. From here, the AI data center and EV design wins start to layer in through 2026 and 2027. The 27% short interest is forced to cover, creating a legendary squeeze that sends the stock flying. The company's GaN plus SiC strategy is validated, and it successfully carves out a high-margin niche, becoming a key supplier to the AI and EV industries. In this scenario, the stock is incredibly cheap even at today's high valuation. The bear case, the reality, is that the pivot fails. The $7 million in revenue isn't the bottom, It's the new normal for a company that can't compete. The big automotive and data center players stick with their legacy suppliers. The Nvidia partnership turns out to be more marketing than substance. The company burns through its $150 million in cash trying to scale a business that never reaches profitability. The 27% short sellers are proven correct, and the stock collapses under the weight of its high valuation and failed execution. This is the risk. With Navitas betting the entire company on this Navitas 2.0 pivot. Comment below. Do you think this is a brilliant strategic move into the AI data center boom or a desperate last-ditch effort that will fail against larger competitors? So, as you watch Navitas whip around in these first few minutes of trading, remember what you're really seeing. The expectation is a simple, high-growth AI stock, a partner to